If you live in Canada and you are over 18, you have access to one of the most powerful wealth-building tools on the planet, the Tax-Free Savings Account, or TFSA. But here's the problem. Too many beginners treat their TFSA like a regular savings account. They let cash sit there, earning 1% interest, while inflation eats away at its value. The TFSA isn't just for savings, it's an investment account. The magic happens when you buy assets inside it, and all that growth and all those dividends and capital gains are 100% yours to keep. The taxman gets zero, as long as you stay within your contribution limits. If you're a beginner, the stock market can be scary. You don't want to pick individual stocks and risk losing half your money overnight. I get it. Today, I'm going to give you the ultimate keep it simple strategy. We are reviewing 4 specific investments that are perfect for TFSA beginners. They are low cost, highly diversified, and you can buy them and practically forget about them. Before we look at what to buy, we need to talk about where to buy it. To buy these investments, you need a discount brokerage. And this brings us to Qtrade Direct Investing. Qtrade has consistently been ranked as one of Canada's top online brokers. And for beginners, it's fantastic for 2 main reasons. First, they offer commission-free trading on all stocks and ETFs. When you're just starting out and investing smaller amounts, trading fees can really eat into your returns. Qtrade solves that. Second, right now, they have an incredible offer. Qtrade will give you up to 5% cash back on new deposits. That is an instant return on your money before you even buy your first stock. If you're looking to open your TFSA or move it to a better platform, check out the link in the description below to grab that cashback offer. Okay, so you have your Qtrade account set up. What do you buy? As a beginner, your first goal is diversification. You don't want all your eggs in one basket. The first 3 investments we're looking at today are what we call asset allocation ETFs, or sometimes all-in-one ETF. They have a little bit of everything. Think of these as a pre-made meal kit. Instead of you having to go to the grocery store and buy 1,000 individual ingredients and figure out the recipe yourself, you buy one single ETF that does it all for you. These ETFs hold thousands of companies globally, from Apple and Amazon in the US to Royal Bank and Shopify in Canada, plus international stocks and government bonds. The main difference between the next 3 picks is simply how much risk you want to take. Number 1, the balanced choice, XBAL. Our first pick is for the cautious beginner who wants growth but also wants a safety net. It's the iShares Core Balanced ETF portfolio, ticker symbol XBAL, currently priced at $33.72 per share. XBAL is structured with roughly 60% stocks and 40% buy. This is similar to a medium risk portfolio that your banking advisor might put you in, except instead of paying 2.20% in fees for their mutual fund, you are only paying 0.18% with this ETF. Another big difference is the amazing returns. This ETF is a great performer. Many investors have been happy with the performance. Last year, XBAL was up 13.33%. This is amazing performance for an ETF listed holding 40% bonds. It was up 46.57% over the past 5 years. With the 60-40 split, stocks are your engine for growth. Bonds are your safety. When the stock market crashes, bonds usually hold their value or even go up, cushioning the blow, and in the meantime, you collect distribution and interest payments from the bonds. So your entire investment is working for you all the time. This is a fantastic set-it-and-forget-it option if the idea of a major market drop keeps you up at night. Number 2, the growth choice, VGRO. Our next pick is probably the most popular choice for younger investors or those with a longer time horizon, say at 10+ years. It's the Vanguard Growth ETF portfolio, ticker symbol VGRO. As of January 7th, 2026, it is currently priced at $43.82. It has a fee of only 0.24 and a 12-month dividend yield of 1.67. You'll see later in the video that you get great growth, and this is a really good dividend. It holds about 80% stocks and only 20% fixed income. So the objective with this investment is to pursue more growth, and it doesn't have as much of a safety net. Similar to XBAL, VGRO is professionally managed, so this gives investors some peace of mind that their money is in good hands. Last year, VGRO was up 16.86%. 2022 was the only negative year of performance since 2019. It was down 11.21% that year. This is a cumulative return of 64.74% over the past 5 years. So it's important to understand that even though this fund performs very well historically, it's not guaranteed to have positive returns each year. So you have to be fine with some sort of fluctuation. For market allocation, it's 45% holdings in the United States and 30% in Canada. But it does have smaller percentages in other countries, and this gives you true geographical diversification. Because it has more stocks, it has higher potential for long-term growth than XBAL. However, when the market dips, VGRO will dip deeper than XBAL. Here are some of the companies being held in VGRO. You have companies like Apple, Nvidia, Microsoft, Royal Bank, Amazon, and more. If you can handle seeing your portfolio drop temporarily because you know it will likely recover over the next 5 years, VGRO is an excellent core holding for your TFSA. Number 3, the aggressive choice, VEQT. So, what if you don't want any breaks? What if you want maximum growth potential and you have a stomach of steel for volatility? Then you should look at the Vanguard All Equity ETF portfolio. Ticker symbol VEQT, currently priced at $55.11, a management fee of only 0.24%, and a dividend of 1.31%. This portfolio is 100% stocks with no bonds or fixed income. It seeks to provide long-term capital growth by investing primarily in securities. Government bonds or other types of fixed income securities offer safety within a portfolio and can also provide income in forms of distribution. Bonds generally don't dip as low as equity markets. That's why they are considered as a level of safety. Last year, VEQT returned 20.45% gain. 2022 was also the only year it had a negative performance since 2020. This gave an amazing performance of 87.51% over the past 5 years. The Sharpe ratio is 1.4. This is good. This measures the returns against the risk of the portfolio. A number above 1 means that the investment is generating a higher return compared to the risk. The share ratio for the previous ETF was 1.2. This is slightly higher. This has a similar market allocation with 45% to United States and 31% to Canada. You will even notice some of the same companies. Again, the big difference here between VEQT and the other ETFs previously mentioned is the level of safety in fixed income securities like government and corporate bonds. VEQT is the highest risk of the 3, but historically, 100% equities have provided the highest returns over very long periods. So you've chosen XBAL, VGRO, or VEQT for your TFSA. Amazing first step, but investing isn't just about buying once. It's about tracking your progress towards your financial goals like buying a house or retiring early. That's why I developed my own personal finance app, financiallywise.ai. Most banking apps are terrible at showing you your true financial picture across different accounts. Financiallywise.ai lets you see your net worth, portfolio balances, savings, and total debt. After 2 months, it will give you a net worth trend. You can also manage your monthly budget, income and expenses, and this allows you to plan for what is left over. Here's your investment accounts and your holdings. The real game changer is it allows you to be your own money manager by setting financial goals like retirement, having a vacation, an emergency fund, and seeing your progress. It also makes recommendations if you are ahead or behind. Track your debt paydown progress. It also has an investment research tool. Just type in the ticker, give it a moment, and all the information will be right there for you, from risk rate, key metrics, and analyst buy or sell ratings. Let's do one for Google. It can help you with figuring out if you have enough insurance coverage. Simple to use calculators. But the best part, because the system knows you personally, it has your net worth, income, expenses, and so on. You can ask it a question like, I am getting a $3,000 bonus. What should I do with it? And it will give you a detailed plan and a breakdown with explanations and reasoning. This app is all about giving you the tools to make financially wise decisions. Of course, this AI can't replace a financial advisor or a planner, and you should do your own research, but this is helping to put you in the right direction. The best part, it's totally free, at least for now. So click the first link in the video description to sign up. All you need is an email. Let us know what you think. Please share with your friends. We would love to see this app grow. So stop guessing about your financial future. Head over to www.financiallywise.ai. Let's get back to it. Number 4, the Canadian Spice, CEW. Okay, our final pick. The first 3 were whole meal solutions. This one is a side dish, not recommended to replace the others, but have it as a side. It is the iShares Equal Weight Bank and Life Company ETF, ticker symbol CEW. Current price of $27.94. It focuses intensely on one thing: the massive Canadian financial sector. It provides a diversified, equal-weighted portfolio of Canadian banks and life insurance companies. Bonus, dividends are paid monthly. Since 2021, it's given double-digit returns. 2022 was the only down year. Last year, it gave a 36% return. Cumulatively, CEW grew 158% in the last 5 years. Simply amazing. This gives you tech like growth and a monthly dividend. My next video will dive deeper into this ETF, so subscribe. The dividend is 2.7. Fee is 0.61%. I'm sure you will recognize some of the names on this list. If you like investing in financial companies, but don't want to figure out which ones are the best, you don't have to. The funds managers here have taken care of that for you. This is a simple solution. It holds the big banks RBC, TD, Scotiabank, and major life insurance companies like Manulife, Sun Life, and others in equal weights. Why would a beginner want this? Canadian banks are world-renowned for stability and, most importantly, juicy dividends. If you love the idea of getting regular cash payouts in your TFSA, CEW is a great way to get exposure to these powerhouse Canadian companies without having to pick which bank is best. Just remember, this is concentrated. If the Canadian housing or financials market crashes, this ETF will hurt. Use it to supplement one of the previously mentioned ETFs, not replace them. Aggressive investors still need diversification, but being concentrated on one industry in one country can be considered too risky. So there you have it. XBAL for balance, VGRO for growth, VEQT for maximum aggression, and CEW for that Canadian dividend income. Here's a 5-year growth comparison between the 4 ETFs. CEW is that bright orange line at the top at 111%. Next is VEQT, the blue line at 71%. Next is VGRO in yellow at 48%, then XBAL at 30%. If you've made it this far, thanks for watching. I'm considering sharing my own portfolio with viewers. Is this something you would be interested in seeing? Leave a comment to let me know and subscribe for updates. Don't let analysis paralysis stop you. The most important thing is to open that Qtrade account, fund your TFSA, and buy something diversified to get started. Check the links in the description for the Qtrade 5% cashback offer and my financiallywise.ai app. If this helped you, hit that like button and subscribe for more Canadian financial tips. Thanks for watching.